G'day folks, welcome back to another update for the S&P 500 and the NASDAQ. Unless you've been living under a rock, you know that the market's taken a dump over the weekend, and the S&P and the NASDAQ are no exception. Also, just be aware for those new to trading and want to learn the basics, we do a weekly video on Basic 101 trading, and the first video we did was last Friday or the weekend, and that was showing how to set up the charts that we use in our regular videos. So reference that, and we'll be doing, the next one will be on money management. So before you can go any further, make sure you hit that like and subscribe button. So first off, in terms of the outlook for the S&P and the NASDAQ, as of today, April 7, the earnings growth, the S&P 500 companies first quarter 2025 earnings growth is projected at 7.7%, the lowest since quarter 3 2023, down from 17.1% in quarter 4 2024. Tariff impacts. Recent US tariffs and retaliatory measures by China have heightened concerns over inflation, reduced consumer confidence, and potential recession risks. Market volatility. The S&P 500 has declined 17% from its February high, with the NASDAQ experiencing similar downturns, reflecting investor apprehension. Valuation metrics. The forward 12-month PE ratio for the S&P 500 stands at 19.4, below the 5-year average of 19.9, but above the 10-year average of 18.3, indicating mixed valuation signals. Sector performance. The information technology sector, heavily represented in the NASDAQ, has a forward PE ratio of 23, suggesting higher growth expectations, but also evaluated valuation concerns. So, as always, we look at the long-term trends. And why do we do that? Well, again, we look at the monthly, the weekly, the daily, and then I'll go to the 1 hour in a minute. But why do we do this? Because we've been projecting a downturn for some time. We projected this retrace this is on the monthly. Let me just zoom in on this one. We've been projecting a downturn from the current few months, and it's finally happened. It's broken below the CCI 150 on the monthly, and the price actually retraced back into that moving average range. But also, importantly, we projected a Fibonacci retrace at the minimum level. Again, I stress this is minimum. It could go a lot further, and that's at 38% minimum retrace. Now, it's already hit that range. This could actually, if this bounces out of there, if that CCI starts rising on the monthly, we should expect the price also to start rising like it did back here. You can see here back in this bearish divergence, that also hit, let me just get rid of that. That also hit the minimum retrace level if we took the retrace back to that, the Fibonacci back to that level. That also hit it, but then it bounced out of there. And since then, we started seeing a bearish divergence at this point here when the CCI was lower than that point versus the price was higher than that point there. So lower highs on the CCI versus higher highs on the price. So again, a couple of scenarios. This could actually bounce out of there like it did here, or it could fall a lot further. And what we do in terms of Fibonacci retrace at all time levels, this is just the monthly we're looking at the moment. It's currently bounced into that 38% range, as I said. The next level of support will be breaking this 38% level. If it breaks below that, then the next level of support will be this 50%, 61%, and so on. If it drops below that 61%, we may have further, obviously, declines. But again, we take it one step at a time. And the way we measure that in terms of the near time frame, we look at the weekly next, and that's already broken as well below that 23 minimum range. And these bearish divergences are all independent on different time frames. They're not necessarily the same. You can see there it's broken well below that 23%. And if we draw a Fibonacci from that high to that low, you can see there it's currently resting at the 61%. Now this could bounce up there from there. And how do we decide that? Then we go to the next level down. Again, this is the weekly. We go to the daily. This is how you break it down and you measure each side. Again, we had another bearish or a double top here on the CCI versus slightly higher highs on the price. Broke down, hit our minimum range there. And that broke further to the downside. Now you'll notice here on the daily, we had almost a double bottom on the CCI versus almost a slightly lower lows on the price. That's a bullish divergence. Now you'll notice there, a bit of a retrace. The CCI did retrace, and that hit our minimum retrace level. So again, if we were to draw a Fibonacci to that high, you can see there very tight 38% retrace. So that also executed with a bullish divergence. Then what did it do? It broke further to the downside, and then it finally came down and rested on before the weekend near this minor support at 50.90, and then once it opened before that, then it broke down below this hard support here at 49.26. So again, a bit of a retrace slightly showing at the moment with a bullish move at the moment today so far. But let's go down to the intraday chart and we look at the 1 hour time frame. So again, we're looking at the daily as a reference, taking short trades only. We don't take any long trades. Remember, the rule is we only trade on the particular time frame we're trading. We trade in the direction of the higher time frame. So here on the 1 hour, we take short trades only. We don't take long trades. Now here we had a bullish divergence, and that also hit our minimum range. Again, this is independent from the daily. So had we drawn a Fibonacci in that little range there, we take it to that point there, you can see there it possibly just touched that 23%. Then it bounced further down. So you would not have taken, we don't take long trades against the daily, remember. We only take the short trades. So that would have been an opportunity to then go short again when the CCI broke below the moving average in that area. The price is already below the moving average, so that would have been a nice little few trades to take if you were trading on the 1 hour time frame. Now further to that, in terms of back testing, just to prove how this works, let me just get rid of this Fibonacci. Okay, so what I've done with the back test, I've started it back here. Again, let me get rid of that Fibonacci. I've started it back here when the price and the CCI broke below the moving averages, and background now highlighted in red, going short only, and that's highlighted by these two strategies. The first strategy, profitability, up here is the stop loss approach, and this one is the average down approach. So you can see there, both they would have entered there and closed out when the CCI broke into the moving average at both of those levels there. But overall, once the price started, or the CCI started dropping again, we had a bullish divergence here again. We just let it run. What we do here with this strategy, we stop it or stop trading on the 1 hour when the daily hits that moving average range on the CCI. Not the price, but the CCI. So here you can see the prices and the CCI are still falling. And at the moment, had you let it run since this period back here on the daily, the stop loss approach has generated 6,436.5, and it's still going. It's live at the moment. Whereas the average down approach, we had an average down there, a couple of average downs, and currently on the average down you would have generated 11,380. That's trading a US for $10 contract. So the NASDAQ has a similar story to the S&P. On the monthly, you can see there we've had another bearish divergence, and that broke down, hit our minimum target. And again, to see if it's going to potentially turn, we look at the lower time frames. On the weekly, likewise, very bearish still. The CCI is still pointing down. And on the daily, we've got a slight CCI break to the upside with a bullish candle so far today, but nothing to go long on. Still predominantly bearish momentum on all the three time frames here on the monthly, weekly, and daily. Then to look on the intraday time frame, again, similar to the S&P, we had another bullish divergence here previously. That just short of that 23-38% level, and then it broke further to the downside. Again, you don't take those long trades. You just potentially take your money off the table or stop going short. Had just seen that, and that would have been probably an area to close out your positions and then re-enter short positions once the CCI broke below the moving averages, as it did back there. And at the moment, if you're going short since then, you're becoming close to closing out your positions once that CCI touches that moving average range. And to look at the back testing for that similar period, you would have started back here when the CCI broke on the daily and the price below the moving averages, and that's marked by this back test here. So on the stop loss approach, you would have generated 1,990 roughly so far. Still, it's live. And on the average down approach, you would have generated 5,128 so far. Again, that'll close out as soon as that hourly CCI touches that moving average range. So in summary, I've been asked the question, do you see any sign of reversal and potentially going long at the moment? Well, I would say the short answer is no, because what we look at, we're going back to the monthly, weekly, and daily for a moment. You consider this the dog and this the tail. The tail actually wags the dog. So what we do is we look at the smaller time frames, and we start off initially with the 1 hour time frame. If that starts showing a bullish momentum, then we look at the daily. So for example, back here, that was the 23rd of March. So if we go back to the 23rd of March, back around this period, there was a bit of an upswing there on the hourly, and that started showing a bit of an upswing also on the daily. So so if you look at the 23rd of March, remember that date? Let's go to the monthly, weekly, daily. That was the 23rd of March there. And where is that on the weekly? So you can see there, the 23rd of March is around this period here. So it depends on what time frame you're trading. If you were trading back here on the 1 hour time frame, you could have made a couple of dollars out of that little upswing there. But again, if you're trading on the daily, you would not be going long on the daily because the weekly is still showing a bearish momentum and so on. So if that starts breaking up and the weekly then breaks up like it did back here, we had a couple of little stuck its head above the moving averages, then we also look at the monthly. So it depends on what time frame you're trading. If you're trading on the hourly, you're predominantly looking at the daily. If you're trading on the daily, you predominantly look at the weekly and so on. So at the moment, there's no sign of a reversal. We look at the hourly first and then we go from there. Again, thanks for watching. And if you're new to trading or if you want to get further insights into the basics of setting up your analysis for review, reference my Pete's Investing +1 videos, which will be posted each week. And the last one we did was chart setup. So that's in the description below. And the next one we'll be doing will be on money management. Thanks for watching and see you in the next update.